This is a strategic briefing brought to you by Capital Root, where we grow smart, build wealth, and retire early. Welcome to the deep dive. Today, we're digging into a stack of sources, really aiming to give you that shortcut to understanding how wealth building works. And we're starting with the absolute basics of investing, but using some, well, surprisingly fun analogies I found: lemonade stands, even pizza.
Yeah, those analogies are great starting points. But beyond the pizza slices, we're really focused on uncovering, those solid strategies for making smart, long-term financial moves. Doesn't matter if you're just starting out or maybe even thinking about teaching your kids, these fundamentals are key.
Okay, let's unpack that first concept then. Our sources talk about a share. They picture it like one slice of a whole pizza representing company. You own a piece, like you could own a tiny bit of Apple or Nike maybe.
Exactly. And what's really interesting is how that tiny slice actually helps grow your money. It's not just owning a bit of the building or whatever. You can profit through capital gains. Basically, selling your slice for more than you paid if the company, the pizza, gets more popular.
Ah, okay, so the value goes up.
Right. Or you might get dividends. Think of that like getting a little cash payment just for holding on to your slice of that specific flavor or company. But, popularity can fade. The company might not do well.
And that's capital loss. Your slice is worth less.
Precisely. Which is why you probably don't want just one slice.
Yeah, that leads perfectly into diversification. The sources hammer this home. Like that office pizza party analogy, you wouldn't just order pepperoni, right? You'd get a few different kinds to please everyone, or, well, to not risk everyone hating the one kind you pick.
Exactly. It's the same idea with investing. Don't put all your money into just one company or even one type of company. Spread it around. Different sectors, maybe different countries even. It cushions the blow if one area tanks.
Okay. But what if the whole pizza market, like the entire stock market, takes a hit? I mean, we've seen that happen. Pandemics, geopolitical stuff.
That's a really important point. The whole market can be volatile. Big events can pull almost everything down temporarily. And that's why investing in shares, well, it really needs to be a long-term thing. It's not about quick wins. It's more like waiting for that pizza to cook properly in the oven. Takes time. Patience is key to ride out those market ups and downs.
Right, patience. So for someone starting out, thinking long-term, wanting diversification, it sounds like a lot to manage, picking all those different slices yourself.
Well, you don't necessarily have to. That's where funds come in. Our sources describe them as like a pre-packed pizza box.
A box with lots of different slices already chosen.
Exactly. Chosen by a professional manager, often. Gives you instant diversification.
Okay, and there are different types. I saw mentions of actively managed ones and then index funds or ETFs. What's the quick difference there?
Sure. So actively managed funds have a manager actively trying to pick winners and beat the market. Costs a bit more, usually. Index funds, on the other hand, just aim to match a market index, like the S&P 500. They just buy basically everything in that index.
Kind of like buying all the pizza flavors.
Sort of, yeah. And many of these are ETFs, exchange-traded funds. You can buy and sell them easily throughout the day, just like a single stock.
Okay, that makes sense. Diversification made easier.
Definitely. But there's one more ingredient our sources say is like magic. Compounding.
Ah, compounding.
Earning returns on your returns, right? It sounds almost too simple.
It sounds simple, but the effect over time is incredible. Our sources show, like, if you invest just a modest amount, say $100 a month, starting in your 20s, that can grow into, well, potentially over $500,000 by retirement, just through compounding. Even if you stopped adding new money later on, it snowballs.
Wow. Okay, so how does a new investor actually harness that power? Our sources mention practical steps, starting with goals. Yes. Step 1. Set specific financial goals. What are you actually saving for? Retirement, a house down payment. Step 2. Figure out your risk tolerance. This is crucial. Are you okay with some bumps for potentially higher growth, or do you sleep better with safer, maybe slower growth? Like, are you a spicy Hawaiian pizza person or a plain cheese?
Haha, okay. Good analogy. And the third step.
Consider dollar cost averaging. This just means investing a fixed amount of money regularly, say, every month. It stops you from trying to guess the market's highs and lows, which is frankly almost impossible. Takes the emotion out of it.
That sounds like a really solid, practical approach for anyone starting. And interestingly, the sources also talk about teaching this stuff early. Financial literacy for kids.
Absolutely. It's about building that foundation young. They suggest things like giving allowances, letting kids make choices with that money. Playing games like Monopoly can actually help too. Talking about wants versus needs.
Simple conversations.
Exactly. even opening a simple savings account to show them how interest works. Teaching assets versus liabilities early on. It's like giving them the secret recipe for financial success down the line.
You know, this whole deep dive really boils it down. Investing isn't some dark art. It seems to be about being patient, spreading your risk, thinking long term, understanding how comfortable you are with ups and downs, and just letting that compounding effect work for you.
Absolutely. It's far more accessible than people think, especially with tools like funds and strategies like dollar cost averaging.
What really stands out is that these core ideas, they work whether you're building your own future or trying to give the next generation a head start.
It encourages you to think beyond just the daily market chatter and focus on that steady strategic growth. It's about building real, lasting wealth.
So here's something to think about. Which fundamental recipe, which simple principle we talked about today will you start using to cultivate your own smarter wealth? This has been a Capital Root Strategic Briefing. Subscribe to unlock your financial future with our deep dive analyses on market trends, wealth building frameworks, tax optimization strategies, and the psychology of early retirement. This is your path to growing smart and building real wealth. Check the description to start your journey with us today.